good afternoon and welcome to another episode of Business Spotlight. I'm very excited today. I've got David from Fundabl. We're going to be looking at a new business, a startup in the capital raising space. David's got a new idea how to solve the problem of businesses raising capital without dilution. So over to you, David. Welcome. Tell us a bit about your business, what it's all about.
Well, thanks for having me. Our business is about making capital available to founders and business owners quickly, typically where they see a need that they need to take an opportunity off the street, or they have to grow, or something's come up that was out of plan, and they need to access capital, and doing so in the other methods that they're sort of familiar with or done previously would be too slow, or potentially involve them giving up a portion of their business. And for small business owners and entrepreneurs, that's the hardest thing. You want to keep growing, you want to execute on your mission. And when that time comes that you need money, oftentimes investors are asking for a share of your business in return. And that's appropriate in certain instances and very painful in other instances where you'd rather avoid it. So we don't see ourselves as a solution where you can just grow the business and never have to rely on outside investors or share equity with anybody. I think there is a place for that. And I think that very early on in businesses, that's important. But we are funding that is available where you're growing really well, you're executing, or you know what you're going to do with the funding, and you need support. And doing so, trying to get it from more other traditional avenues could end up seeing you diluting ownership or taking quite punitive terms given the speed that you need.
Fantastic. And what's the genesis story of Fundabl? Why did you do it? How did you get into it?
Yeah, so I have a background in finance. I've been in finance my whole career. I've done it through sort of various lenses. I started out doing private equity and real estate investing. I moved to Australia from New York, actually. And when I got here, I joined a startup in the finance space. We did principal investing, and it was a boutique finance house. So I learned the Australian market, and I had the privilege of working from a financial perspective with a lot of Australian entrepreneurs. Both to invest in their businesses or advise them or sometimes buy them as well. And I ended up then moving into one of our portfolio companies, which was a startup to build a non-bank lender. And the idea of that business, it's called Credible, was to be a non-bank lender to medical professionals, to service doctors, dentists, and vets as well as possible and look after them for their needs throughout life. And so that was sort of my first foray into startups and into solving a specific lending problem for a community. And learned a lot there. I was the chief operating officer, so I was responsible for building the funding platform and making sure that we could originate as many loans as the sales team could bring in. And after doing that for about 4 years, it sort of got to the point where the business was doing really well. We had done over 2 billion of lending, and it was sort of just time for that next challenge and sort of, going at it again. So I sort of come from a flavor of finance. I understand the space, and I was serendipitously introduced to my co-founder, Ethan, who was trying at the time to set up a fintech to solve a problem for business owners, entrepreneurs to access capital. And so when we got introduced, we decided to give it a go. It was at a time when we were in the hard lockdown in Sydney, so we didn't really have any other options while we were sort of in our free time. So we spent that time looking at how we would launch this business and thought about how we could service the Australian market differently to what was available for business owners currently. And that was in late 21. In 22, we raised capital from our strategic investor, EG Funds, and we opened our doors to make the first original loans that Fundabl did early last year. And since then, we've basically been growing. We've been focusing on understanding as many different segments of the SME market. And I include in SMEs, startup businesses, scale-up businesses, and just businesses that have been in Australia for quite some time. They're sometimes family-owned. Sometimes it's not about hyper-growth for them, but they're doing a great job and they still need to access capital. I think working capital is a thing that plagues every business of every size, from the very small to the huge. And so for us, it's really about, can we offer funding that is simple, easy to understand, and the timing of it solves the problem that you need it for. Our product is really good for companies where they know what they'll do with the money and the return on that money when they deploy it. It's not so good if you want to use it experimentally and sort of spend it and hope that it works, but you're not exactly sure what the return will be. In that scenario, I think equity is actually a better solution.
Interesting. Yeah, that's a good frame of reference, I think, for business owners to think about the options. I like that. Very good. You mentioned co-founder there. What's been what do you think the advantages of having a co-founder, and then what are some of the challenges?
So I think the advantages vastly outweigh the challenges, and definitely it's a big preference for me. I think that business is a team sport. I think that getting different perspectives and leveraging different skill sets is really valuable. So for me, I think, you know, being a founder, being a business owner is extremely stressful a lot of the time. There's a lot to focus on, and there are a lot of different problems, some seen and some unforeseen, that come up. So having support, both mentally and from just a morale perspective, but also just hands on deck to cover it, is super valuable. And I think doing something in a vacuum, you know, is very difficult. I think all great people will tell you that when you look behind the curtain, there's a team of people that have supported them to make them a success. It's not really a solo journey, even though they might be on the face of it. So for me, it was never really attractive to be a solo founder and try and hold on to everything, but then also just, you know, be a one-man wolf pack. I think having a founder is a huge benefit in that regard. And the only real cons to speak of might be a bit of sharing of direction, that, you know, there's a little bit more consensus building. And obviously, if there's more than one person, your ownership in the business is a bit lower. But for me, they're vastly outweighed by the positives.
Excellent. Yeah, great to hear. You mentioned starting in COVID with the lockdown. So it means you're a relatively young business. What's been the most surprising thing along that short journey?
I think the most surprising thing is how technology businesses and entrepreneurs and business owners have fared and how good they are at being adaptable. I think when COVID struck, I remember personally looking at this and thinking, how will people manage? You know, what are we going to do? You can't go outside. We don't know if we go to the supermarket to buy groceries, if we could die of a deadly disease here. And, you know, how are businesses going to manage to get to the other side of this? And I think the really surprising thing has been what a good job everyone has done. And, you know, without going into specifics around who's done what, I think as a coordinated effort between government, between attitude, between people banding together, and between people being entrepreneurial and business minded, it's been amazing to see the bounce back.
Yeah, excellent. So that's a reflection on your customers or the market.
Absolutely.
So what's some of the trends in your space that you're seeing now or seeing coming up in the near term?
It's a great question. I think definitely we're seeing, and I mean the recent news of banks in the US and obviously UBS buying Credit Suisse sort of as a sort of backdrop for it, we're seeing people getting a bit more skittish around where their capital is going to come from, who's going to support them when they need lending. So when you know, in our sort of much more micro part of the market, the business owners that we're serving and speak to all the time are saying that they may have a relationship with a very big bank, but dealing with the process of getting additional lending or changing the facility or accessing working capital has become very, very challenging. So in terms of a trend, I think there are a lot of lending sources that are just much more circumspect about what they're willing to do at the moment. So the process to access funding is harder, the benchmark to access funding is higher, and uncertainty as a result of that is also higher. So I think in terms of trends, non-bank lending, other forms of capital have a real place because it just gives another option to businesses where otherwise they may be stuck dealing with their existing relationship or with lenders who are just much more concerned. And obviously the other thing that's going on in terms of trends is we're in a rising interest rate environment. So that obviously adds a whole different dynamic to what your cost of capital is going to be, what kind of capital you need to have available, and what might happen to you depending on what your forecast is versus what's actually happening in your business.
Yeah, interesting. It's It's been a while since we've seen rising interest rates.
Absolutely. Absolutely.
Okay, so if we look to the future now, where do you see Fundabl in, say, 12 months' time? What does the future look like?
That's a great question. I think Fundabl started out specifically focusing on businesses that were growing really quickly. And this business owner, you're growing really fast. You need capital to continue taking advantage of that business opportunity, which is creating value for you and your shareholders. And in order to do that, you need funding. You don't necessarily want to do an equity raise or a long process to access venture debt or other types of lending, but you know what you would do if you could access $500,000 today, let's say. And we were looking to give this capital to these business owners so that they could immediately deploy it and continue on their upwards trajectory. I think what we've also seen is that there are a tremendous amount of really good businesses out there that don't necessarily find us at the moment when they're growing really, really fast. They might be on a more moderate growth trajectory. They might be many more years in business. I mean, we've dealt, one of our clients now has been in business 30 years. So that's a company that's not obviously growing at 25+% per year. They've sort of moved into another phase of their journey, but at the same time, they have the same needs for working capital and opportunities they want to take advantage of. So I think in 12 months, the diversity of the types of customers we'll be serving will be much greater. I think we'll enjoy a little bit more credibility in the market, which will mean we'll be able to access our own funding, which we obviously make available via these loans at a cheaper rate. And what that does is it allows us to lend out this money at a cheaper rate, making it more accessible for more clients. And then lastly, our initial sort of product is a 12-month or less product. So it's a shorter term solution. You get the capital, you use it for the short-term strategy that you need to execute, and then you pay it back to us. But there are many of our customers that take the money, they use the money, they get to the other side, and it's a real shame for us to then part ways and say, you know, we've had this relationship, we know your business really well, we know what a great management team you are, but we can't offer you the next type of funding that you may need in your business now that you've solved that short-term problem that you may have had. So I think the next thing we also want to do is add a different product that looks after existing customers that have moved on from, you know, our working capital style solution and continues that journey in, you know, into the future. I think being able to offer capital to your best clients throughout their journey is ideal, and we would want to extend our relationship as long as possible.
Yeah, interesting. And what do you see as some of the challenges to getting there? What are the headwinds for you and your business in the next 12 months?
So look, rising interest rates affect everybody, and we're sort of no different. I think we are facing the same kind of challenges as our clients in a funny way. We're growing. And so we also have to raise equity for our business, which obviously involves us going to market and trying to get investment. And that's a very tough thing to do this year relative to the previous sort of 5 or 10 years that we had. So that's a challenge that we've got to overcome, just like every other business owner. We can't rely on debt exclusively either. And then, of course, the faster we grow, the more funding we need to access in order to continue servicing clients that are looking for capital. And in a rising interest rate environment, controlling those costs and making sure that from a treasury perspective, we can manage that risk is going to be an important challenge for us to overcome.
Yeah. It's interesting that you're in it as well, which is, I guess, refreshing for your customers to know you're living it as well.
Yeah, that's exactly right. You know, when they come to us and they say we need a bridge round, we're in the middle of a capital raise, it's taking longer than we expected, we really understand what that's like. And we're sort of setting ourselves up to try and make the process of navigating that as easy as possible.
Got you. Turning to you, David, how do you, as an entrepreneur in this startup going in the scale-up phase, how do you keep yourself improving current? How do you work on your own development?
Look, in terms of my own development, I'm a big believer in trying to seek out mentors and accessing mentorship from as many different sources as possible. So from a personal perspective, I try to surround myself with people who've either gone on a journey similar to mine, but are further along on that journey, because that obviously gives me amazing access to insight that I'll otherwise have to experience firsthand over time. And then equally just getting diverse perspectives. So I'm very fortunate in terms of our investor base currently. As I mentioned earlier, we've got EG Funds as a strategic investor in our business. So the CEO of EG, Adam Gehar, is an extremely dynamic CEO. He runs a team that is national in presence. He's actually got quite a big office in the Philippines as well. While it's not a lending business per se, it is financial in nature. And so he's solving a lot of the same problems I expect to go through over the next sort of 3 to 5 years. So having access to him is amazing. We also have Matt Leibovitz, who himself is the CEO of Stake, the stockbroking platform. So Matt, again, is, his last raise, I think, was 90 million. So he's gone through the phases that we are trying to follow in. So having that access to somebody who's in the trenches, just like us, growing a business and, tackling the challenges of today is great. And equally, just from an industry perspective as well, I think the finance and fintech industry in Australia is great in that it's quite close. It's everybody kind of knows everybody, and there's quite a collegiate approach to a lot of things. So being able to, I guess, have access to my peers and my colleagues in the industry has also been great. While we may compete over certain clients or in certain spaces, there's still a lot of ways that there's collaboration and knowledge sharing, which sets me up as a business owner and entrepreneur to have as much success and make as few critical mistakes as possible.
Nice. Okay, and just thinking about, I'm sure there's going to be lots of business owners watching this saying, I wonder if I should be talking to David. What are the types of thoughts, questions that might be in their mind, your typical client that you help, where they'll say, that's me?
Look, I think what's happened for them is they have a plan, they have their projection for the next year, and they're either outperforming that plan and saying, you know what, there's some incredible opportunities that if only I just had a little bit more money in the budget, I'd be able to tackle those. So those could be opening an office in a new location, or at a rate per unit if you just bought some more, or hiring some top talent into the sales team to grow sales. And they're sitting there saying, look, everything's going well, we're growing, it's good, but if I could just put a little bit more fuel on the fire, it would be even better. That's where you sort of want to be coming to Fundabl. Our sweet spot is sort of $200,000 to $1 million of lending. You can access that funding very quickly and utilize it in your plan for the next year. It could also be that you've had that plan and something unforeseen has happened. Maybe you had exposure to Silicon Valley Bank. Maybe you had a situation in one of your regions where there's underperformance, or somebody's left the business and you need to replace them, and all of a sudden there's an unexpected spend. That's where, again, typically you might have to go back to existing shareholders and say, hey, can we have a bridge loan? Can we sell some more equity to get the funding in that we need? Because we need to solve this problem that's occurred. That's where I think Fundabl's a nice option, where you can come to us, we'll make that capital available to you very quickly. You'll use it in your business and you avoid having to go through dilution. The other thing is, you might be in a situation where you need capital and you probably need a significant amount of capital, but you'd like to go and do that raise either when you are in a place that the business is more stable, or when you've got your sales up to a certain level, or you've got that office in a new location stabilized, and you just like some capital in between to keep yourself operating business as usual until you can go after that bigger capital raise. Because at the end of the day, raising capital, whether it's a significant loan or equity, is very defocusing. Management has got to go and meet with a lot of investors, make presentations, do due diligence periods, and it's quite an intensive process. And so being ready and doing it at the best time for your business is ideal. And so again, that's where we found customers using Fundabl's money to continue business as usual and set themselves up for that concentrated raise at the time that suits them.
Fantastic. And so if that is you, and you're going, yeah, I'm in that phase, I urge you to reach out to David. His details will be in the notes below. David, thank you for sharing some brilliant insights, not only to your story and your journey, but how business owners could think differently about accessing capital, because it is as you say, the fuel on the fire many times. So thank you very much.